Good evening, everyone. Vern Gowdie here again, and I'm joined tonight by my special guest, Catherine Cashmore, editor of Cycles, Trends and Forecasts. Hello, Catherine.
Hi, Vern.
How are you?
I'm great, thanks.
That's not what you were saying before.
What I was saying? No, just entering.
News of a
lockdown 6.
Yeah, lockdown 6 in Melbourne.
yeah, it's great living here in Melbourne.
Oh, well, it doesn't. These lockdowns, don't seem to have any impact on the property market. So they're not infecting those in such a bad way, are they?
Yeah, well, you say that. I mean, I think that's because everyone's just looking at prices and they're thinking, well, prices are going up. And over the last 12 months, it's been unbelievable. I mean, I say that having predicted it, having forecast it in, Cycles, Trends and Forecasts. We were always saying that post this mid-cycle recession, that we would experience, that globally we would experience the biggest land boom in history. And at that time, you make these forecasts and you have to put them out, and you put them out strongly, but you still got to live through it. You still got to live through that uncertainty as to whether it's going to pan out, as expected. And it's exceeded all expectations. What can I say? I mean, Sydney, 19% in 12 months. Tasmania's beat that. Sydney always takes off, so people need to be a little bit aware of that. Sydney and Melbourne. So Melbourne's got a 16% in 12 months. Other states are lagging, but a lot of that has to do with the sales process. I think that people don't understand how the auction market affects the speed of price rises. It's very, very, I mean, purchasing real estate always has an emotional component to it anyway. And when you start to see properties sell on the street and going quite far over reserve because buyers are being run up against each other in a very highly emotive situation, that exacerbates the booms. And also the other way, when the market starts to fall and you see properties passing in, it exacerbates that fear that we're in free fall. So it's not surprising that we've seen that. We've seen that happen quite often over the last, 3 cycles at least. But yeah, I mean, you say the lockdowns aren't affecting the market. They actually are. So when you look past all that price increase and, headlines that come up in the newspapers, the thing that really signifies a healthy market is very high turnover. So a lot of sales, and then you can look at it out by looking at the total value of sales that take place. So in each state and territory, normally those figures are published by CoreLogic. So it'll give you the total value of real estate that's been sold. And that gives you an idea of the amount of stock that's being sold. And when you see those numbers start to come down, that means actually there's more of an indication of the health of the market. And obviously in Sydney, the lockdowns do affect it because nobody can inspect a property. People don't want to buy property sight unseen. The volumes are coming down. So that whilst prices are still being paid because of all those other drivers like interest rates and not a lot of stock on the market, and where else do you put your money in infrastructure, and everybody knows now. Everyone knows the big secret's out, right? The government backs the property market, right? Everyone knows this is, you go and put your money anywhere, you put it into land, and the government will back you. They're not going to let land go backwards if they can at all help it. It's still that the actual overall health of the market needs to be taken in context of that. So the lockdowns do affect it, and they have affected it in Melbourne exactly the same. It just puts you can't do anything in a lockdown. So
which kind of it brings me into your monthly issue that you've just published, which was the timing the Brisbane 2032 Olympic Windfall. So last time we spoke was I was in quarantine. I just come back from the UK, so it's about 6 months ago. And in that 6 months, what's happened here in the South East Queensland area? Obviously, everyone's getting everything before lockdown in the background there.
Oh, is it too noisy?
Yeah, just a little bit of feedback. Yeah.
No,
you're right.
Is it good? Is it okay now?
Yeah, that's good. Yeah. Perfect. But there's especially on the Gold Coast here, the market's gone crazy. So I'm just looking at going into 2032 with the Olympics. Is there any more upside in this, or do we run into a 2026? Does it come off and then it's better to buy after that, leading into 2032? What's your view on that South East Queensland market, which has been a beneficiary of people migrating up from Sydney and Melbourne?
Well, a few points with that. If people wait until 2032 or the 2-year lead up to the Olympics to purchase, then they're going to be missing out on a lot of good gains in the interim. And as you suggest, a lot of that is to do with population growth. But notably, that population growth doesn't just pour into Brisbane; it's pouring into the other major cities around there as well. So in areas where there isn't a lot of supply on the market and land isn't in abundance, you're going to see those price rises push through. But there's no immediate stop to that yet. So even if you are not a student of the cycle that we promote in Cycles, Trends and Forecasts, even if you're a little bit, worried or wary about whether can this possibly go higher, noting that in every year, the same question is asked. I mean, people were saying that in 2018, they were saying it in 2019, they were saying it last year in 2020, and prices have gone up a few $100,000 on certain properties from where they were last year. So the reason the boom's not going to tie up in Brisbane, though, is because or South East Queensland, is because the rental market is in, as they say, a rental crisis there. And rents are covering the interest payments on the loans. There is energy to go yet in that market, and that doesn't last forever. Land price, you borrow to buy, you don't borrow to rent. So land prices will gain more than rents will. There's more demand for land than to push more energy in land prices going up than there are in rents. But right now, it's almost a no-brainer to buy a property and let the tenant pay down, tenant pay off the interest, and hold a good piece of land in a good area where everything indicates that the market's going to take the gains of the infrastructure payments, take the gains of the continued low interest rate environment. Even though there are rumours about lending rates going up, it's not really significant enough to pull the market back from where we are. So it doesn't mean that the market's always going to go up, where I'm talking about these numbers of sort of 13, 14 to 19% per annum. But notably, we have had that happen in the second half of the cycle before. So, I mean, I write Cashmore's Real Estate Wealth, where I talk about very specifically about picking property at the right time in the cycle, in the right area. And if you do that, you can get 4 to 5 years of that kind of double-digit price growth. They call it capital growth in the industry, but it's not really capital growth. It's land price inflation, land and location price inflation, and you can get that going on right up until the point of the cycle. And I don't think that Brisbane will slow down too much. My feeling is that Brisbane's going to go right through to where we're predicting the peak in 2026, whereas I think there's a good chance that Melbourne and Sydney could slow prior to that, because they will top out. They've gone too fast, and other states are looking more preferable. And obviously, with the work from home migration, you're going to see that play out.
So keeping on this Olympic theme, if I award the bronze medal to Brisbane, South East Queensland, reading from your article, the gold medal would go to Perth, and maybe the silver to Darwin in the next 4 to 5 years. Is that what you see?
That's what I forecast. Perth and Darwin. Look, Perth and Darwin. They're not really. It's not so much that they follow the property cycle, more so mining investment cycle, and we're seeing a lot of that happening, and a lot of growth in that sector. We're also seeing population growth that's coming from that, because workers are being encouraged to move into Perth, and that's filtering again into very low vacancy rates. And even though Perth is a slow starter, because it's a very different market in Perth. I mean, I put a little bit of this in the monthly issue, but when I purchase a piece of real estate here, it's not the vendor expectation I'm worried about. It's where the other buyers are. And just to give you one example, I attended an auction just this Saturday past where the property was quoted 900 to 990, and the vendor's reserve was at 990, and the property ended up selling for 1.51 million. Right?
Wow.
So it
That's
just
in
went.
Melbourne.
That's in Melbourne. I mean, look, it's a little bit smoke and mirrors here, because to be honest, it was always going to go well over where they'd quoted it. So it wasn't that it gone as high as the headline shows. And if any of your listeners want to check out Daily Reckoning, I wrote a piece in the Daily Reckoning Australia today, which kind of outlined that a little bit. But in Perth, it's totally different. I mean, there aren't auctions in Perth. People are used to putting down offers that are subject to numerous conditions, unlike the market here in Melbourne, where you only stand a chance of securing something if it's a totally unconditional offer. And if a vendor expectation in Perth is around, the 680,000 mark, and I move very quickly on it and put down what they want and put a short lapse time on the offer, so put a little bit of pressure on them to sign, I can usually get a deal over the line. I'm not run up against other buyers. And so the Perth market tends to be a little bit slower in pace, taking off. It's not pushed up as much. And people over there also have memories of the long downturn as well in Perth. I mean, they really did
After
suffer.
the mining boom.
Yeah. So, I mean, I think Perth will gain energy and it'll gain confidence. And, in 2 or 3 years' time, it'll really start to go. We'll see, whether that's going to play out. It's a little bit speculative. And, what should be noted from anyone listening, always good to go in and buy on that speculation. The only thing I would say with it is that Perth does have historically long periods of stagnation. So if you buy into the Western Australian market and you go into the bigger cities and buy where I've kind of forecast that land inflation to happen, be aware that once we reach the peak, right, and we come to another inevitable downturn, and it will be another worldwide led recession going into 2027, 2028, land prices will be affected to one degree or another, depending on government policy and the economic environment. But you could go through another long period of stagnation. So that doesn't happen so much in Melbourne and Sydney. They tend to rise in the first half of the cycle, go down a little bit in the mid-cycle or stagnate, and then up into the second half and down. But they will exceed the previous peak in the first few years of the next cycle. Now, Brisbane will probably do that as well because of the Olympic Games. That could bring a little bit of energy in the lead up and speculation, and that's already happening now. So I have had a lot of buyers that have contacted me and said, well, should we be changing where we're looking for property and going into Brisbane and buying there? So yeah, it could do well. But that's how I see it.
Because you talk about those suburbs in and around that 5 to 10K from the city. I think you were talking about that last year in one of your issues about for South East Queensland. I think it was Morningside, Camp Hill, and a few of those inner city or inner eastern suburb type areas.
If you buy well, then you should actually you can get decent growth. It doesn't, when we're looking at the growth of a state, we're looking at the median price, and the median price covers a lot. It's just the middle figure of a group of sales. And so it can look like an area hasn't done very well. Or when I'm saying, for example, that Melbourne's going to pull up early or Sydney's going to pull up early, it doesn't necessarily mean that the McKinnon school zone in Melbourne, which is actually one of our smallest school zones here, if you buy a good property there, it's going to pull up early, because obviously there's constant demand from people that need to live there and will be prepared to pay to live there, whether it's a soft market or a hot market. And that was the case in Brisbane. So in Brisbane, even though the median price of Brisbane as a state stagnated for a decade, and unit prices went backwards over that period of time. Unit prices taken into account that they also count for townhouses as well as apartments, but that didn't mean that you couldn't get growth over that period. So it's so important for people to remember, and I think this is the problem. There are a lot of spruikers in the property world, and these are people that make a lot of money selling their courses for a few thousand, and once you've sold a few hundred courses for a few thousand, you don't really need to have your feet on the ground, walking the streets, talking to sales agents and buyers and sellers and getting a feel for what's going up and what's going down. And people can lose a lot of money in the property market if they don't buy at the right time, the right time, the right property and the right price. You really need to be very careful. And if you do that, then you will make gains, and you'll have, and as long as you understand how the cycle works, you'll have a lot of security. It's a very safe form of investment then, because of how our economy is structured. But you can lose a lot if you don't get it right.
Yeah, you talk about the spruikers. I'm not sure if you were in Australia when Henry Kay, I don't know if you remember him. He was in Melbourne, and it was a shocker. Oh yeah, his real estate courses, and I think one of the government agencies caught up with him in the end.
Correct. He went in front of ASIC. And what they were doing, they were selling the options, and options are highly speculative. They were selling them based on rezoning, speculating that these blocks of land were going to be rezoned. I don't know whether this was what he was taken into in front of ASIC for, but I know that a lot of people got caught with land that was, dead money going nowhere.
Worthless.
It's actually, options always looks really good, and it can be. So what buying on options is putting very little money down or no money down, and effectively going into improving the land and selling the land on, right, without actually and taking the profit from it without actually being involved in paying stamp duty or being involved in the transaction. It can be extremely profitable, but it's a hard work to find a price. You are dealing with, everybody owns a block of land, right? So you're effectively going into a joint venture with the owner of that land, negotiating what you're going to do to it, taking on the risk and flipping it on the other side can be very profitable. But I think people get fooled into thinking, and no wonder, because we're in the same industry. We sell our forecasts in a sense with a headline. We want people to open them up and to read them. And the headline from the property industry has always been that you can, make millions with no money down. It's a great headline, right? No, everybody wants to do that. But it's really difficult to do, and you can lose a lot of money from it. So you have to understand the environment, and that's what I'm trying to do through the stuff that I write. Just in Cycles, Trends and Forecasts, but also in Cashmore's Real Estate Wealth, trying to educate people on that side of it, so that when you do invest, or if you do decide to go do options, or if you decide to do a joint venture, or if you want to do a development, or even if you want to invest overseas, that you really are buying something that's going to perform as you would want it to.
Yeah, you rarely get handed anything on a platter, and the spruikers, this is this deal for you. It's all packaged up. There's all these layers of costs in there. So you've really got to do the legwork and know the market.
Yes, 100%. Yeah, and in Australia, that's relatively simple. And as long as you follow some good formulas with it. But yeah, I mean, as we said, there were areas of Brisbane that did okay during that 10-year period. So they did actually increase around 7 to 8% capital growth, per annum over that period, where everywhere else was stagnated. But you just got to understand the formula.
So if you were going to buy into one property, that's all you had the money for, one market, Brisbane or Perth?
Well, it depends
or Sydney
on
or
what
Melbourne,
you want. Yeah, it depends on, first of all, how long are you going to hold the property for? So that's a real thing to take into consideration. So if you're going to say, well, the next 5 years to the peak of the market, and then we're going to sell out, then that's the first question. Because if you're going to sell out, then both are still open to you. But taking into account what I just said to you about, if you were to purchase in Melbourne, for example, and you wanted to hold 10 years, then Melbourne's probably going to do all right in the first half of the next cycle, but Perth might stagnate. So those are the things to look at. The next thing to consider is what your budget is. So in Brisbane, you've got higher prices to get. If you wanted to buy in that city, you've got higher prices to get into the gooder areas in that city than you have in Perth. So in Perth, you can get quite close to Perth Central in areas that are getting a lot of infrastructure investment and gentrifying very quickly in the 600s. And you can buy, always what I suggest, if you can do it, if you're looking just for growth, is to buy the full blocks of land that have the potential to be split into two. They don't need to show that they'll give you an instant profit straight away. It's just having that potential, because that's what makes land valuable, the ability to develop it, right? Otherwise, it's just a house. It's a house like a unit. It's just what the buyer's going to come along and pay in the future, more. But having a decent rentable house on a block of land that you can split into is always your best recipe for getting the most capital growth that you can. The other thing to take into account then is your yield and your holding costs. And both cities are showing impressive yields, but Perth, well, rents in Perth are going north at a very quick pace. So even though Perth prices have gone up, I think 10% over the year, rents have gone up 16%, which absolutely has to feed into the price of the land. That's why I'm confident those markets are going to continue to increase, because as rents go higher, the bank's going to be willing to lend you more because the earnings of the property are looking good. And then when the bank lends you more, prices are going to be bid up more, right? Because people have got more to spend. And as prices are bid up more, then it becomes profitable for developers to build, right? Because people can't afford to buy the full blocks of land, so they're happy to buy the half blocks of land. So the developers know that. They'll know that first, and you will be able to recognize it as you monitor how many development applications are going through council. And then once you see that starting to pick up, you've got gentrification. You've got population growth into an area that has limited supply and the land needs to be split up. That's where the larger land sites start to get really profitable, because then you're owning something that is decreasing in supply as the blocks around it are split up. And that's how the cycle works from beginning to end. Once you get to that max and the prices have gone so high and a lot of debt has been poured into the land and the productive sectors of the economy have been eroded away, you absolutely have to have a downturn. Now, whether that is a mild downturn as we had in 2008, or whether it's going to be a severe downturn as we had in the early 1990s, depends on a lot of factors, but you have to be prepared for it, right? Because it will happen. The property just can't keep floating upwards and upwards and upwards. And it's really important to understand this, because I had a meeting with a very intelligent man that is is running a property company here, and we were having a chat, and he said, well, I think it's very safe, because in the 1990s, median prices only went down 10%. And I said, well, again, the median price covers a lot, right? Because if you look at the sales records and you look at the repeat sales data, and you find properties that sold in the late 1980s for, say, 800,000 in Melbourne, because Melbourne really suffered. Brisbane, not so much, but Melbourne really suffered in that downturn. A few years later, they were selling for half the price in the 400,000s. And you can find numerous examples of it. It was a very severe and very prolonged downturn.
I remember it well.
Yeah, the recession hurt a lot of people, and it hurts you even more when you haven't got your housing equity. And once you haven't got housing equity, you can't borrow any money. The bank doesn't want to know you. It only wants to know, you go and try and get a business loan and you don't have any collateral for that business loan or whatever. The land is used as collateral for all the banks lending, pretty much, the larger percentage of it. And we know that, and it gets worse as you get to the end of the cycle. So going through those downturns where you don't have access to money, you can't sell your biggest asset or lean against it, hurts the rich and the poor alike. So we could have that, and in fact, records show on the cycle that if you have a very bullish if you have a very mild downturn, one downturn you can have a worse downturn the next downturn. It just seems it patterns like that overseas, and it's patterned like that in the past here.
Yeah, I remember that 1991. It was the old joke was the last person to leave Melbourne, please turn the lights out, because it was just suffering so bad. I forget, was it the Kerner government was in then, or and that's what brought Jeff Kennett into power, I think, after that. My sister and her husband moved down to Melbourne around that time from Brisbane, and they just hit the sweet spot. They bought in Glen Waverley and did quite well out there.
Yeah. I mean, it's not a happy situation, to have to be in, and I want people to be aware of that. This is why, look, the 18-year cycle, it's actually 18.6, and the reasons for that are all in the modules of cycles, trends and forecasts, which I've written, over the months, and I've put a lot of knowledge in that. I think often people miss the gold that we put in to these editions, but there's a lot of gold in there and a lot of detail.
Mm-hmm.
If you understand that cycle, it's very powerful knowledge, because it's giving you the exact dates of where these significant downturns are going to happen. And obviously, making money in the bull phases of the cycle is what we want to do, and people get caught up doing that. But having that roadmap and understanding the gravity of it, to understand it's not just another cycle. It's not just where we see, people that trade on the stock market, they talk about 2-year cycles and 4-year cycles and whatever else. It's much more significant than that, because land sits at the base of the economy. We need land for everything around us is made from land. We live, eat, breathe, sleep on it, work on it, play on it.
Mm-hmm.
You need to understand what a huge impact it has on the economy, and the reason that our downturns are so significant, whether you have investment in the land market or not, is because all our financial system is choreographed around that market. And so knowing where those downturns are, understanding how the land market affects the stock market, because a lot of the stock market is made up of that economic rent, that unearned gain from land. Understanding what those effects are gives you great comfort, because you can then have a roadmap of which to work out what your investments are going to be in the interim, how you're going to make money in the interim. It becomes a lot clearer, a lot more understandable. So when you understand that, and when you understand how the land market works and how it affects the economy, then very powerful knowledge.
Yeah, and you mentioned earlier about that process of going from development into gentrification. Yeah, I know you've put together an excellent flow chart of how that process works to, when there's just development and then goes through this gentrification, and I forget the other steps of it. I was reading it before, but I'll actually include that when I send this out on Tuesday, so people can have a look at that. It's a good logical flow.
Absolutely.
I think you developed it, didn't you?
Yeah, I did because I see it on the ground all the time, and you need to understand that everything in Australia starts from population growth. So people talk about, we need wage growth, right, for land prices to rise. Well, you need to understand how it works at a micro level, because the ripple in real estate is wage growth into an area of limited supply. So you have to search for those areas of limited supply, like a middle ring suburb that is trapped on all sides by other suburbs, but perhaps it's a little bit more desirable than those other suburbs, so people want to live there. And you have population growth that goes into there, and then that population growth triggers off a whole process that happens after that, including, as I've just explained a few minutes ago, about the splitting up of the land, and the council under pressure to build more infrastructure to cope with the increasing population. And more infrastructure means land rezonings, and land rezonings mean land price inflation. And then once that has exhausted itself, you'll find that suburb will peak out, and then it starts happening in the neighbouring suburbs. The last thing you want to do, and I've said this before, is go into a new estate where there's oodles of land that the developers have and drip feed onto the market in staged releases, which keep the prices high. And not only that, but they chop the land down minimally. You're paying more for the property component of the real estate than you are for the land component, and the property component depreciates, and the land can't appreciate because more and more stock is coming on. And the only time that those suburbs go up in price and you get out of that stagnation is when the area gets completely populated, and then the population will start to grow, and then the council will do something like, well, we better put a train station here, or we better improve the roads, or like they did with Tarneet in Melbourne. They put a train station there, and then suddenly whoosh, prices start to go up. Now, you don't want to buy, if you don't know your timing of how that works, you can buy into an area and be sitting there for 3-4 years before you get any growth. If you understand how that process works, you can buy into an area and get immediate growth, and then you will also understand when that area is likely to top out. What do you do then? Do you do a development? Do you sell off? Do you try and maximize the income of the land by I don't know, well, we're not in the right atmosphere for it now, but Airbnbs, or turning it into a property that can be rented separately, so which in some states is a lot easier to do than it is in Victoria. But there's a lot of options that you have when you've got land. Do you split off the backyard and sell it off to somebody? Do you build in the backyard and sell where you're living and go and live in one property and rent the other out? There's things that you can do. It's a little bit like when you buy at the wrong time of the cycle. If you buy at the right time of the cycle, when you see where you have to buy when the market is on that cusp of a turn, and there are indicators which give you that, right? And if you know those indicators and you move at that point, you're going to get what I said, that 4 to 5 years of really solid price growth before you get a leveling out. If you don't and you buy at the wrong time, you're sitting on prices stagnating or going backwards if you bought at the peak and we're going into a downturn. So it's not a 100% can never go wrong formula, but there's certainly a lot, that you got better chance of getting it right than wrong if you understand how it works.
And you talked about population growth, but we're seeing with immigration, those numbers have been cut back and may well be cut back for a little bit longer. How does that play into it? Does it alter that cycle? Does it change your forecasts?
Yeah, it does. It does on a state by state level, because Melbourne's market has always run from population growth. That's how we've been a bubble, that bubbles up and down, because it's the Ponzi population economy, right? And when you lose it, you've got problems. We haven't got problems at the moment because people are drawing their money out of their term deposits and putting it into real estate. There's such a energy for where do we invest, and so that's happened. And then we've had the government stimulus with the home builder, and so we've got a lot of building of accommodation where first home buyers are moving out of where they're living right now. They're renting, moving out of their rentals and moving into their first home. So eventually it will slow the market up. But on the other thing that is the other states are experiencing, obviously, is interstate population growth, because it's Melbourne and Sydney that have had the bulk of overseas population. And when you add that to the interstate population growth, that's why their markets have done so well. So that's why I think the other states are going to have more energy in the market. But the other thing to take into account, of course, is that we have had a lot of building activity because of the home buyer grant. But at the same time, the cost of building has absolutely jumped,
gone through the roof
to record levels. I mean, I think timber prices, what did they went up 380%. We've got like bricks, the price of a brick has doubled. The labor costs have gone up tremendously. Right now, it is really hard for small developers to find any block of land that's suitable for development, because the land prices have jumped, and then when you add the cost of building materials and labour to it, and in Perth it's so bad that you've got companies approaching traders on other sites to try and lure them away to their own sites.
Incentives.
Yeah.
My wife's cousin, he's a builder and he's renovating his own home, and he can't finish it off because the cost of products have just got from when he originally started. And he's doing all his own work. He just said the cost has gone up dramatically.
Numerous people in that position, and a lot of the home builder first home buyers. I think there's quite a large percentage that do not know when those homes that they got the grants to build will be completed. And the only thing that I was going to put this in a future monthly, I was thinking of doing it for this month, but the only thing that's going to, what you will see over the next few years that will really come from that is 3D printing, because 3D printing a house is very cheap. And you can use all sorts of materials for it, a lot of recycling materials, and then you take the cost. This is really giving a future issue away, but you take the cost of a property down from, say 400,000 to build to use a big company. Actually, it costs a little bit more than that in some states, but 400,000 to build a decent townhouse, down to 4,000 to 100,000. The costs, you're really slashing the costs of building. Now, you have to understand that the gains of that will be bid up in the land prices eventually. If it's cheaper to build a house then you've got more money to spend buying the land, right?
Yes.
Because all the costs are done. But it depends, it depends what areas that we're talking about and whether the land is already owned and, sort of how you do it. But, and it's got a little way to go because you need the, actually the printers are quite expensive. You need a company to be constructed to become a 3D print. It's not like you can go out and buy your own 3D printer, right? And then, well, you can if you want to, but you're spending a lot of money to buy the printer to do one house. You'd be cheaper just to use a building company. But yeah, I mean, you need, and there are industries in Australia that are now setting up that are doing the 3D printing, and they will take off because it's a lot cheaper than waiting for imports and dealing with the construction as we have it now. And that will probably play into the next cycle. By the time we get to the next cycle, you could see the next cycle really disrupted because we have what you had in America when Suburbia was built with so the car took you further out, and then William Levitt came in with his mass-produced homes, manufactured homes in factories, like the 3D printing of the post-war era, where they worked out how to build properties cheaper with all modern facilities and build them on cheap land. And suddenly it took all these people out of the city. And so you have a little bit what's happening in Melbourne now, people leaving the city. So not as much competition for the sites in the city and moving out to suburbia. And then you didn't have so much of a boom. And the significant lesson out of that is when you don't have a boom in real estate, you don't have so much of a bust in real estate. And when you don't have so much of a bust in the real estate market, the economy bounces back faster than it would otherwise do. And we kind of seen that a little bit with COVID, with all the incentives that have prevented, defaults on mortgages or a large number of foreclosed homes hitting the market. The economy can recover very quickly, and of course, then the housing market goes, as we forecast, goes crazy. But that's what happened in the 50s, mid 50s. The end of the 18-year cycle downturn wasn't as severe because of that process that happened in the run-up.
So keeping on this Olympic theme, I'm going to do what could be a Stephen Bradbury here. What could come through and surprise on the 18-year cycle that you've had? Because I've read a lot of stuff, and you've got guys like Michael Burry, from Big Short fame, saying this is the greatest speculative bubble of all times and all things by 2 orders of magnitude. And Jeremy Grantham saying this is serious. This is today a really impressive bubble in the US equity market. There is nothing like this even in 1929. So you've got some pretty astute bubble watchers out there who are sounding the warning on a US equity market. And we know whatever happens at Wall Street sort of flows over everywhere else. What happens if that does, if the US equity market does meet a pin? Could that disrupt the cycle?
Yeah. So I just want to say a little bit about that. The cycle continues because, first of all, the cycle can only be disrupted if you take speculation out of real estate. Otherwise, it will boom and bust at those time frames that we've forecast. That is 100%. The problem is the trends that you have going on. So obviously, we're not just looking at the real estate cycle in CTNF, we are looking at other cycles that go on alongside it. And we have huge economic changes happening at the moment, which is part of a much longer cycle. So that is the move to digital currency. And in order to move to digital currency, I believe that we're going to go through a financial disaster. The monetary system, in a way, has lost all its trust, right? The monetary system is going to be taken away as we know it, and it's going to be replaced with a digital system. Now, that's not going to stop real estate inflating, but it is going to cause pain in the interim. And everything that we're seeing now, really, I mean, if you read books like The Fourth Turning, I don't know whether you're familiar with that book, where it talks about a much longer cycle of the winter phases that we're going through now, and a lot of change is sort of coming ahead. So I do think that those forecasters that are talking about that have a point that the next few years aren't necessarily going to be easy years, even though we're saying, well, the markets are going to boom. It doesn't mean that there's not going to be, panics along the way. And it doesn't mean that, there's not going to be a lot of pain, as we're seeing even with what's going on with the COVID problem. The one thing that I think that really could interrupt the cycle is war. Because if you, again, we're right at the time for it. If you look at cycles, even such as the Kondratiev wave, where you do get wars leading up to the peak of that cycle as people fight for the natural resources that are available. People fight over trade routes, and we've seen that with what's happening in China. With the Belt and Road project and in the South China Sea, and the international, the tensions that have come over that. I mean, it's all that news has been pushed aside, because the only thing that you ever hear in our mainstream channels is everything that's going on here to do with COVID and this obsession over a couple of cases all the time, as if it's, and we're just not looking at what's happening elsewhere. People are missing that. So I really feel that those are the things that could potentially disrupt the cycle. And if we did have some kind of significant event that was going to come toward the end of this cycle, and it could happen anywhere between 2023 to the end of the cycle, that again, this is all written in CTNF over various editions of various weeklies. But if it did happen at any point in that, it absolutely could disrupt the cycle. And those disruptions normally come at the peaks of the real estate cycle, as we're approaching the peak of the real estate cycle. And if that happens, then you could be looking at a long period where you don't have any speculation going into real estate, or long periods of stagnation, or even long periods of recession or depression, depending on policies and government action and how it plays out. So all of those things are there's so much that you can predict, where you can look and you can think, well, there's a warning there, and then there's so much that so you've got to be aware and you've got to be warned for it. But I can't see right now, between now and the next few years, up and towards that peak that we've forecast, and I'm quite confident about that peak in regard to the work that I've done on it and the additions that again, all of that in CTNF, that I can't see anything that's going to interrupt that. The way we're going at the moment, nothing's going to stop people going and purchasing land. You would need significant policy changes to do that. And as we've seen, both sides of government are backing the land market, with the Labour government now coming out and saying, well, we're not going to do anything to touch it. We're not going to, it's tax policy. People invest how the tax policy dictates how people invest. All I know is if I start talking to you about tax, I'll go on and on moaning about how much tax I have to pay. But yeah, I mean, a lot of tax that people don't want to be income taxed, because all your income, your tax on income is very high, and land is one way to start reducing your income taxes. And the tax on land, as opposed, I know people that we do have a land tax here. I get that. People always say, you talk about land tax, we pay land tax and it's a lot, but it's not a lot compared to the capital gains that you get on land. Otherwise you wouldn't invest in land if it was a really high land tax that you were paying on land. If the government said, right, we're going to tax all the gains that you make on land away, but we'll let you keep your income that you earn. We don't even want to know what you earn from your work, right? You would have a very different economy than we have right now. And people wouldn't be pouring their money into land and hoping that they're going to get 200,000 or 300,000 in a few months. And that is possible, by the way. I purchased, just to give you an idea, the land market is moving very quickly. I purchased for one of my clients in December last year, in a suburb, actually in Aspendale, which is a suburb on the bay, southeast of Melbourne, sort of down the bay. Quite a small block of land, 40 square meters, and we bought it for 3-bedroom suburban home, not a lot done to it, very basic, could be rentable. We purchased it, I think, for 960,000. The last month in July, properties on that same street, same land size, same style of home, 3-bedroom suburban homes have been selling over 1.2 million. So the prices are moving. It's just, quite extraordinary. If you understand, like I said, where to purchase, where to buy, those are the types of gains that you can get in the bull faces of this market. But I mean, that you don't worry, you might grumble about the land tax that you have to pay, right? But your gains are pretty good in comparison to that. Now, that's why you're investing. You're not investing for the rent of the property. We're not like America, where you're getting yields, 14, 15, 16% in some states of America, but you're not getting any land inflation, and so people pay very low prices for the properties, but they live off the yields. It's a very different market over here. People don't buy for yield so much. They want their property price to go forward, and they want the barbecue story, and that's why people invest in land. It's the our tax policy. So of course, I always talk about that because it's important to understand that unless that changes significantly, and this is it. This is how the property cycle is going to go. People are going to invest where they're going to be able to keep as much money of their own money as they can without it being taxed away.
But to some point, the capacity to borrow act as a governor, because I wrote about this recently. That even if you go back to the early 90s and you bought a place back then, the interest rates were say 10 or 12%. For argument's sake, well, a lot of your repayment, more than half was going in interest costs. These days, a lot of your repayment is going in principal costs. So even if rates went to zero, there's still a point where you can't borrow. If you're on $100,000 a year, you still couldn't borrow $10 million, for argument's sake, because on a 30-year loan, you'd have to pay back $300,000 in principal a year. So does the capacity to borrow act as a governor at some stage, and we're just working our way there as rates have got lower?
Yeah, of course. A property's worth what the bank will lend, apart from right now where people are pulling money out of term deposits. And I've honestly never had so many cash buyers that have come to me. And it's quite remarkable how much money they have in term deposits. But the 100% it does, but you need to understand what's happening right now. So sure, I actually think interest rates will go negative. I think the cash rate will go negative, and it is not unprecedented to have mortgage lending at negative rates either. It has been done, and it is being done in other countries.
Scandinavian countries, so.
Correct. Yes. So in the Netherlands, you've got negative interest rates on properties. But people, when the first thing to say is that when people get a mortgage, they do it like a gym pet. They're worried about what they're paying each month more so than the overall of what they're paying. That's they want to know that they can afford the monthly payments, and they're not necessarily, so concerned about that. But the other driver that is a massive driver to this land inflation that we're going to see over the next few years is the fractional purchasing, which the blockchain is accelerating. And so now buying a token of real estate is becoming, we're playing catch up in this country. It hasn't taken off here as much as it has overseas. But setting up, big, first of all, companies on, in the States, for example, big players on Wall Street sucking up, heaps of real estate and creating real estate funds out of it. The ability over here to buy, we have the companies come out with BrickX and I'm trying to think of the name of the other one. It slipped my mind now, but there's quite a few. Domicom is another one, but there's others there where you can group together and buy real estate. And of course, with the you can buy it in crypto, real estate in crypto. So Bitcoin payments can be made for real estate in both Melbourne and Sydney. People can sell their home for crypto, and obviously, the blockchain is allowing immediate real estate transactions in real time for you to buy and sell parts of real estate as you never have before. And we all know what the end of the story is, right? It's like obvious that this is it's not a sustainable way of doing it, but who cares? Right now in the interim, it's a bit like the crypto mania that's going on. It doesn't matter whether you think it's going to, whether you believe in it or not.
Or bust.
People are making a hell of a lot of money off it in the interim. It might be worth nothing, right? Imagine the non-fungible, products that people are, investing their money in. But
invisible artworks. Yeah,
that's right. Yeah, it's just incredible. Yeah. So again, another thing to understand, the golden rule of how our economy works is that all that money flows into the real estate market, flows into the land market. Why? Because land is the only thing that everybody needs, but is short in accessible supply. So sure, we have so much land in Australia. We're not short of land. We're short of land that people can live on, accessible land that has got electricity and facilities and community and everything around. And we know from the lockdowns how important community is. You die without community. Oh, my heart goes out to everybody in New South Wales or Sydney who's living through that long lockdown at the moment, where the cure is worse than anyway
disease.
than the disease. I mean, just a horrific situation to be in. But that's the land that people want, and it's short in supply. And because it's short in available supply, it's the biggest purchase people make, and the more money they have, the more they will pour into their land purchase to improve their living situations. This is our life. This is where our energy is. It's all tied up with where we live and our local communities. And so that saying, Phil Anderson used to talk about, the land takes the gains. That's a very Georgist principle, Henry George economist principle, is that land takes the gains. So you have a lot of wealth being made somebody who's got a lot of wealth being made, you can bet that's going to filter into the land market. That's where it's going to end.
I'm interested, because I've been following that trend in the US with regards to the institutions buying up residential housing and just making it very difficult for the individual purchaser because they can outbid them. But that notion of fractional buying, that's an interesting concept where what you're talking about buying a tenth of a block, and that style of thing. Is that what you're talking about?
The property is purchased and then you take a share in it.
Yeah, you take a share in that. Like you might buy 1/10 of that block of land. You and nine other people.
Yeah, you just they create shares from the property, so you own so many shares, in that property, or so many shares of the value of that property. And so it's not like you have a little bit of the title or like a strata title, where you own a share, a piece of the entire building. It's a little bit different from that, and that's why I say it's tokens. It's like that. Sort of token, you own a token of real estate, a share of real estate, and I mean that's how it's being funded and done. And most of like the REITs, really, the REITs, the real estate investment trusts that are set up. A lot of them are set up obviously against commercial land, but that's now filtering into the residential market. Again, in Australia, somebody is working on this, giving too much away, but there's people that are working on setting up, residential real estate trusts here, and they have already been done in the States. What the idea is to speculate on the capital growth of the property, not just on the rental income, which of course in commercial real estate, commercial real estate is a big market. You've got industrial and retail and office, and so the industrial market right now is getting a lot of land price inflation, but typically commercial real estate that you're purchasing it based on the earnings of the land, what the business or the rent or it's worth that. It's not worth what a home buyer is going to pay in a few years' time. But the residential real estate trusts are speculative. They're speculative based on the growth, and that's why that this boom in real estate is going to be the same thing as you see in the crypto. It's going to the moon, right? This is why it's one of the biggest drivers that we've got going into the real estate market, because when it comes too expensive for you to purchase, and we've seen this already, then the first thing you think about, should I purchase with my brother or sister to get into the market? The first home buyer is pushing it up from the bottom end, and when it becomes too expensive for that, then it becomes, well, I'm not going to buy. Why should I buy real estate? Particularly in the trends that we're going to now, where a rent a property and I'll just have a hand in the market. At least I've got a share in it. I've got a share, so I've got a part of it. So I mean that's really when you it's such a huge driver, like I said, and the blockchain that backs it, and that's the technology is developing so quickly around that. Goodness knows what kind of structures that we're going to see as we go over the next 2-3 years.
Yeah, I remember back in the late 80s, early 90s, there was a group out of Sydney, and it was a family, and it was Fred, I can't think of his last name, and they ran real estate investment trust, property, housing in Sydney through that. That was the late 80s, early 90s. It was it was Fred Johnson. I can't remember now. It's a long 30 odd years ago. I'm testing my memory. But yeah, so it's not without precedent here in Australia. I have seen it.
Interesting. I'll look into that because I've not heard of that.
Fred, and I can't, and it was a family, and it's it was, oh geez, I'm going back maybe 89, 90, it was around, and but I haven't heard of them since. But yeah, they raised quite a bit of capital to invest in Sydney.
Yeah.
But I imagine it's all been sold off, and I don't. Fred Jones, no, not Jones. That's too easy. Johnson, it escapes me.
Yeah, you need more of that resveratrol.
I do. Yeah, I'm still on it.
Yeah, me too. Yeah.
and so feeling good.
Good.
Yeah.
Yeah.
Oh, Catherine, it's been wonderful chatting to you again. You're a font of knowledge on the property market. Obviously, we've covered a lot of things in general here, different areas. But the flow chart I'll include in my update to readers next week. But I think how you assess markets. It's a unique insight, and the cycle. I'll be interested to see how it does play out, because I see these other trends building in the US equity market that they look at and they go, wow, is that getting close to topping out? And if that does, where does that flow to? Or does the Aussie market here just keep moving on and stick with that cycle?
Yeah, well, there is there's a fair amount of research on that in CT&F regarding the equity market and whether it would top out early. And of course, I don't think it will. I mean, it doesn't mean that you can't have panics, along the way, but to see another significant downturn, we do have a few more years to go. And that's based on quite a long history, right? So again, like all of that sort of gold is dipped into some of the issues that we've written in CT&F. So that's the sort of forecast I'm sticking with. But obviously, people are going to be wary of that, just because in every cycle you think that there's something different. Well, years ago we didn't have this, or the lending's so different now. We've and it's true, we're going into a different economic system, and that has to have an effect. But like I said, until you particularly in the real estate market, until you really change people's mindset towards that investment through taking away all the gains, that they can make from it, capital gains, that people are still going to speculate. Yeah,
but again, someone's, you often talk amongst our friends, and they say, how are the kids going to afford to get into the market, with the way it is? But it still doesn't seem to that impediment.
Well, yeah, they're going to take advantage of the government's home buyer scheme and the real estate grants that they get and the record low interest rates. And if that fails, they'll buy with a brother or sister, or they'll settle for a token of it, or buy a very bad investment. They'll buy an apartment, which is the worst thing. Please don't, first home buyers, don't go and buy an apartment, even if they look cheap and you think, well, surely the price has got to go up. Don't do that. You got to look in this country, you got to look at real estate as an investment, not a home. I mean, it's just not treated as a home here, and we don't have to agree with that, and we don't have to like it, right? But you make a big mistake if you don't take into account the investment potential of what you're purchasing, unless you're intending on being there for life and never moving, and not worrying about ever using your property as a bank to borrow against, or the equity to borrow against. So that's how I always talk to my clients about it, even if they're, whether they're home buyers or investors. That home buyers or first home buyers, I should say, because obviously investors are thinking about it. But yeah, you want your property price to go up as much as it can, because that's what's going to be securing your wealth, a big part of securing your wealth for the future.
Yes, and on that note, we went for a walk on the beach this morning, and there's an old shack on there. It's owned by this elderly couple, but they must own the block next door as well. And they've just sort of put a little lean-to onto that, and I suspect that's to just sort of mitigate land tax because we put it all under one title. But those two blocks are probably combined with about 15 million, and she was just out the back hanging washing out over the veranda. It's just, you talk about, something for the long term. They probably bought it 30, 40 years ago and just haven't moved. and
Yeah.
the wealth of the land in that is just unbelievable. But I just don't know how they pay the rates. The rates have to be something like $50,000 or $60,000 there.
Wow. Yeah, incredible, incredible. But yeah.
So that's long-term wealth creation out of land.
Correct. Yeah.
Anyway, Catherine, it's you've generously given us an hour of your time. So I'll let you better go home and get ready for your lockdown at 8 o'clock.
I'm going to enjoy. Yeah, I've got. I'm not sure how much. I've got about a couple of hours freedom, I think.
Freedom, and we'll settle in and watch the Olympics tonight. Yeah.
Yes. Yeah. Oh gosh. Yes. Good idea. Take away the sting.
Yes. Thanks, Catherine.
No worries, Vern. Good talking.
Cheers. Likewise.
Talk
Bye.
soon. Bye.
Bye.